Hi, everybody, and welcome to You Can Be a Stock Market Genius. Let's get started on lesson number 3, which is going to be the order types you can take and how to make money in the stock market. So let's get started. So basically, in order to buy a stock, you got to make instructions either to buy or sell a stock on the exchange. And when you put that order through your E-Trade or Fidelity account, it gets sent through a broker and then it goes to the exchange, and it's all based on the auction market. And when your order gets filled, it's executed, it went through successfully. So let's take a look what you need in order to put your order in if you want to either buy or sell a stock. You got to put the order type, which I said it's buy or sell. The ticker, for example, Apple's AAPL. Quantity, how many shares you want to buy, 100, 1,000, a million. Then you go into decide what position do you want to take, either buying it and selling it, and the price, either the market price or the limit price. So that's basically your order to either buy or sell a stock. Let's take a look what a market order is. Now, when you put in an order, if you say a market order, it gets executed immediately at the best available price. So if you're buying something at 50 bucks and you say I want to buy it, it may be at 51, 49, depending on how volatile the market is. It always gets filled what the market is open at. It's the simplest order type, but unfortunately, as you can see, you don't have any price control over this. So you should use this when you want to either quickly enter and exit a position because speed is more important than the price. The next order type is the limit order. Now you can buy at your price or lower, sell at your price or higher. And the reason is limit order. It really gives you full price control. It's most commonly used, but the caveat here is you cannot guarantee that it's going to get filled. So what's more important on limit order is the price matters more than speed. For example, you want to buy Apple at $100. You put in your limit order, it's trading at 120. End of the day, it never reaches that $100. Is still trading at 120. It doesn't get filled. So it's whatever the price you're saying you're going to either buy or sell something at, and that's the limit order. It gives you price control, and what matters is this is the price versus actually filling the order. Alrighty, so a stop order is really for risk management and triggers at a set price, and then it becomes a market order. Now, this is really great for limiting losses and risk management. You buy a stock at 50 bucks, you decide, hey, if it falls below 45, I want to get out, and you don't have to really watch. It's kind of putting automatic instructions saying, look, this is the most I want to lose. And because the stock can even fall further, it could go down to 30 bucks. So the best thing for you to do is manage your risk by putting a stop order. It automatically helps you and protects your losses that can even get bigger. So the good thing about this one is great for risk management, and you can fill it at the market price, and that's a stop order. So we have another order if you want to sell or buy something. It's a stop limit order, and it triggers at a set price and becomes a limit order. So here you get price control. So you decide, hey, I want to sell it at 45. You bought the stock at 50. The most I want to lose is 45, and you put the limit at 45. So you're saying, look, if it goes below 45, I'm not going to sell it. Anything higher than 45, I'm willing to get out. So it may or not get filled depending how the market is and the volatility. So the great thing about this one is you get to trigger not only the limit order, but also the price floor. So which is great. So again, the only caveat is it may not get filled depending on how volatile the market is. So quick recap, market order, hey, it gets immediately filled as you put it in. Guaranteed, yes, it's great for speed. Let's take a look at the limit order. Fills only at your price or better. So price is not guaranteed. You have flexibility on price, but speed is not as important. So you decide something's worth 45. That's the most you're going to pay. And it's selling for 49, and you put in their order for limit, it's going to only get filled at your price. Stop loss orders are great. It triggers it, and then it turns into a market order. You buy something like I said at $50, and you decide that hey, the most I want to lose is 45, $5. Market may have got volatile, and it helps you on loss protection. Great for risk management. Stop limit orders. You're saying, hey, if it drops below price, this is the maximum I want to either lose, and puts the floor, and that's the limit order. And price is not guaranteed, but at least you know exactly the most you want to lose. All right, so that's a quick recap of the four orders. Let's take a look at how you can make money in the stock market. We'll keep it simple for now, and we'll give more advanced lessons later on. This one is going to be going long, saying you're bullish on the market. You're going to buy something at a low price and sell at a high price. For example, you may buy something at $10. You think it's worth really $20. You want to get out at 20. So you're going long the market. Going short the market means you're going to borrow the shares, sell it, and buy it back cheaper. You may think that Tesla is overpriced. It's not worth $400. You think it's worth 200. You'll sell it short, and you will buy them back at a cheaper price. Now, the other thing you can do is remain flat. That means you really don't know. Maybe the market's too volatile. There's a war going on. You think, you know what? I don't want to hold any positions. I'm just going to wait and see what happens. So right now, you're not holding any positions. You're kind of waiting and seeing where the market's going to react to, either to a war, oil prices. Hey, things can go down, and you may be able to buy things at a lower price. Again, you're not sure. So being flat is also a great strategy. It's not always you got to take a position. You can stay neutral and stay in cash. So these are the three ways to make money. You can go long, which means you're optimistic. Going short, you're thinking it's pessimistic, that, hey, based on your calculations, the stock is only worth this much, it's overpriced. And kind of staying neutral on the sidelines until you have a better idea with confidence what position you want to take in the market. All right, so going long, like we said, you purchase a stock, and the profit is when it goes above the price you paid. It's quite straightforward. You buy Apple at 150, you sell at 180, you made your profit of $30 a share. Now, going short, a little bit more detailed. Again, you're borrowing the shares from the broker. You sell those shares at the current price. Say you sell at $100. You wait for the price to fall. It goes down to 75. You buy it back at 75. You made 25. You went short. It doesn't mean always you have to go long the market. You always can go short also. And the thing is, you make only a profit when the price goes down. The only caveat here is, like I put it in the asterisk, if the price rises, you lose money. So if it goes to 125, you lost $25. So it goes both ways. But going short, you got to think about not only being right that, hey, the stock is overpriced, but also your timing has to be great. So going short, it's a lot about timing, and also the market agreeing with you that the price is going to go down now. You could be right, but it could be, a couple of years later, it may go down. So here, it's a little bit tricky because you have to be right. Not only that's going to go down, but your timing is more important. So that's a little bit of a caveat and tip of the trade. All right, being flat, having no position, you really are not sure whether the market is going to go up or down. There's a war going on in Iran. You may think that oil prices may go up. You're just waiting on the sidelines. No risk, no reward. You're not buying anything. Sometimes the best thing to do is kind of sit on the sideline with cash until you have clarity which position you should take. So that's also a great strategy. Doesn't mean always you have to take a position, and that's being flat. So, like we said, and how it all connects, long and limit order. You can also go into a little bit more detail. You can buy Tesla. If it dips to 200, you place a buy limit at 200. If filled, you ride it. If it goes up to 240, your profit is $40 a share. Short and stop limit. Hey, you want to think that a stock is short. It's at $50 too high. You want to limit your losses. You place the stop limit at buy at 55. If the price shoots up and can go to 70, but you're saying, look, I want to manage my risk. I want to get out at 55. That caps your losses. So remember, stop limits and stop loss orders are great to make sure that you manage your risk when you trade to avoid taking bigger losses. Again, like we said, flat means, hey, you're just waiting on the sidelines. Alrighty, so key takeaways for lesson number 3. An order is just really giving trade instructions to the broker, what type, what is the ticker, what quantity, and what side you're taking and what price. So the market order is always speed, limit order is about price control. All right, so 3 ways we discussed: going long, buy low and sell high; short, you sell it high and buy back low; and being flat, and that means no risk. All righty, we'll get some great lessons coming for you with more great tips. Just want to give you lesson number 3, kind of get everybody up to speed on the basics. Then we'll start deep diving into more of the strategies that you can use. So like and subscribe if you found this helpful. You can be a stock market genius. All right, everybody, have a great day. We'll connect again soon. Take care now. Bye-bye.